Hey, wealth builders, welcome. Comment the country you're tuning in from. Let's see how global our squad really is. How should you react to the massive economic upheaval that is looming? The world is undergoing changes rarely seen before, where global markets are being redefined under the pressure of crucial geopolitical decisions. The strain on the global economy has never been more intense since the 2008 financial crisis, and today we are facing something even more worrying. On one side, you have China implementing increasingly aggressive trade policies, and on the other side, India's ambition to become the world's leading economic power continues to grow. In this unstable environment, every decision directly impacts your portfolio. But what does this mean for your finances, your investments, and more generally, your standard of living? We've all witnessed these turbulences, but perhaps you haven't realized that these events, though they seem distant, actually affect you much closer than you think. Because in reality, what's happening today on the world stage directly reflects in your bank accounts, your investments, and your savings. Welcome to this new video. If you are new here, I invite you to subscribe and activate the notification bell so you don't miss anything. Today, we're going to explore what these new geopolitical dynamics mean for your savings, your investments, and how you can respond now to protect yourself. Let's begin by understanding what's happening. China's growing influence. China, which has historically relied on exports to fuel its growth, is now entering a new chapter, an increasingly aggressive trade policy. With its new restrictions, it is imposing tariffs on key sectors, from raw materials to technology. In the past, China's economic growth was driven largely by exports, but today, its strategy is shifting. Rather than just exporting goods, China is attempting to position itself as a leader in high-tech industries like artificial intelligence, renewable energy, and biotechnology. This move is not just about boosting China's economy. It's a calculated effort to outmaneuver its rivals in a new era of global competition. China's government has enacted policies to protect its domestic industries and reduce reliance on imports. One of these is a Made in China 2025 initiative aimed at making China self-sufficient in 10 high-tech industries. As part of the strategy, the Chinese government has imposed strict tariffs on foreign goods, particularly in sectors like semiconductors, robotics, and electric vehicles, which are crucial for their next phase of industrial development. If you are invested in industries that depend on these technologies, such as semiconductor manufacturing or EV production, these tensions are already affecting their stock prices. And if you have investments in China itself, especially in tech stocks, the situation is becoming riskier by the day. India's economic ambitions. On the other side of the spectrum, India is making bold moves to position itself as the next economic superpower. India's rapid growth in recent years has been nothing short of impressive. With a population of over 1.4 billion people and a burgeoning middle class that is beginning to reshape the global economy. India's economy is diversifying, with significant investments in manufacturing, technology, and infrastructure. The Indian government has announced plans to become a global leader in renewable energy, with ambitious goals for solar power and electric vehicle production. The country's ambitious strategy for growth is not just about domestic consumption, but about gaining more influence on the world stage. India is positioning itself to become a major competitor to China in the global supply chain, and its growing influence in sectors like technology and pharmaceuticals is already changing the dynamics of international trade. If you're invested in emerging markets, India presents a compelling opportunity. However, it's essential to understand that India's rise also brings risks. As the competition heats up between India and China, there could be significant disruptions in the global supply chain that could affect the value of your investments in both countries. Global trade war impact. Now, let's talk about the ongoing global trade war and its effects on the financial markets. The trade war between the United States and China has been dominating the headlines for years, but it's not just about tariffs. It's a battle for global economic dominance. The United States has long been the world's largest economy, but China is quickly catching up. This has led to a shift in global trade patterns, with the U.S. increasingly focusing on reducing its trade deficit and boosting domestic manufacturing. At the same time, China is attempting to break free from its dependency on foreign markets and become a dominant force in high-tech industries. In this context, the volatility of global trade has far-reaching implications for your finances. If you've been following the headlines, you've likely noticed that trade tensions are affecting the stock market, particularly in industries that rely on international supply chains. For example, if you hold shares in companies that import raw materials or components from China, or that rely on Chinese consumers for their products, your investments may already be taking a hit. The trade war is not just about tariffs. It's about the global flow of goods, services, and capital. And when that flow is disrupted, it creates uncertainty that reverberates throughout the economy, currency volatility, and inflation risks. But that's not all. The global economic landscape is also marked by increasing currency volatility. As countries like China and India continue to pursue aggressive economic strategies, the value of currencies like the yuan and the rupee is becoming more unpredictable. The U.S. dollar, once considered the world's reserve currency, is now facing challenges as the Federal Reserve has raised interest rates to combat inflation, making the dollar stronger in the short term. But this strength comes at a cost. Higher interest rates mean higher borrowing costs, which can slow down economic growth. Inflation is also starting to creep up around the world. In the U.S., inflation hit its highest level in over 40 years, driven by supply chain disruptions and rising energy prices. This inflationary pressure is not confined to the U.S. It's a global phenomenon, and when inflation rises, it erodes the purchasing power of your savings. If you're invested in cash or low-yielding bonds, inflation could significantly reduce the value of your money over time. The same is true for the euro, which is also experiencing inflationary pressure, particularly in the wake of Europe's energy crisis. The impact of geopolitical decisions on your personal finances is not limited to the volatility of the markets. Sectors that were once considered safe and reliable are now becoming uncertain. For instance, the tech sector, which seemed to be a safe bet, is now facing unprecedented turbulence. The trade war between China and the United States has already caused a dip in the value of stocks of major tech giants, and this is just the beginning. But that's not all. Commodities, another pillar of traditional investments, are also experiencing extreme volatility. Oil and commodity markets in flux. Oil stocks and rare metals, which were once a cornerstone of many investment portfolios, are now under extreme pressure. In the past, these commodities were considered safe investments, as oil and precious metals like gold had long been stable sources of value, often acting as a hedge against inflation. However, the geopolitics surrounding oil and other raw materials has changed, particularly in light of global supply chain disruptions and the growing tension between oil-producing nations. China, for example, controls a massive share of production of rare earth elements, which are essential for many modern technologies, and its increased control over these resources has direct repercussions on global prices. These minerals are vital for producing electronics, electric vehicles, and renewable energy technology. The demand for these materials is expected to increase significantly over the next decade, but China's growing monopoly means that any shift in policy or trade relations could disrupt the global supply. If you have investments in these sectors, the situation is becoming increasingly risky, and it's crucial to understand the larger economic forces at play. Moreover, as the world pushes for greater renewable energy adoption, the demand for certain metals, such as lithium, cobalt, and nickel, is surging. These commodities, which were once considered niche, are now central to the global energy transition. However, they are also becoming highly volatile, driven by shifting geopolitical relations, particularly in the context of the trade war. As electric vehicle production accelerates and new green technologies emerge, the prices of these materials will continue to fluctuate, and this volatility is something every investor needs to be prepared for. Currency wars and economic instability. Meanwhile, the euro and the dollar have never been as strained. The euro, once considered stable currency, is fluctuating violently against other currencies, particularly the dollar, creating uncertainties for those with foreign currency investments or assets denominated in dollars. This fluctuation is exacerbated by the policy changes of the U.S. Federal Reserve, which has been raising interest rates to combat inflation. While a stronger dollar may seem like an advantage, it also means higher borrowing costs for businesses and consumers alike, which can slow down the economy. At the same time, the euro is facing its own set of challenges, particularly with the economic strains of the European Union, which is yet to fully recover from the economic consequences of the pandemic. The question is, how do you protect your savings in this global monetary instability? The truth is that currency volatility is something that all investors need to consider. A sudden change in the value of a major currency can significantly affect the value of your holdings. For example, if the dollar strengthens too much, it could lead to a drop in demand for U.S. exports, harming American businesses and leading to losses in the stock market. Similarly, the euro's depreciation can make European exports cheaper and more competitive, but can also lead to rising costs for European businesses that rely on imports. Strategies for currency hedging. One way to hedge against currency volatility is through currency ETFs. These exchange-traded funds track the performance of foreign currencies and can provide a way to offset losses from adverse currency movements. For example, if you anticipate that the euro will weaken against the dollar, you can invest in an ETF that tracks the performance of the dollar relative to the euro. This can help protect your portfolio from sudden shifts in currency values. Another way to protect your portfolio from currency fluctuations is by diversifying across different currencies. Rather than holding all of your investments in US dollars or euros, consider holding assets in emerging market currencies, such as the Brazilian real, the Indian rupee, or the Chinese yuan. While these currencies come with their own risks, they can provide a hedge against the potential collapse of major currencies like the dollar or the euro. Additionally, many emerging markets are growing rapidly, and their currencies could outperform more established currencies over the long term. Real estate and inflation-proof assets. If you're looking for a more stable investment during times of global economic uncertainty, real estate continues to be a viable option. However, even the real estate market has not been immune to the pressures of global geopolitics. As trade tensions escalate and supply chains are disrupted, real estate prices in certain markets are becoming increasingly volatile. In the U.S., for instance, the Federal Reserve's interest rate hikes are leading to higher mortgage rates, which could dampen housing demand and slow the real estate market. Despite these challenges, there are still ways to make real estate work for you in an uncertain economy. One of the key strategies for minimizing risk is to invest in real estate investment trusts, REITs, which allow you to invest in a diversified portfolio of properties without having to directly purchase physical real estate. REITs typically focus on properties that are immune to economic shocks, such as healthcare facilities, logistics warehouses, and data centers. These types of properties tend to have long-term tenants with stable contracts, making them a solid option for those looking for reliable income streams during uncertain times. Another way to approach real estate is by investing in international properties. Some emerging markets, like Southeast Asia and Latin America, continue to see rapid growth in their real estate markets, driven by strong demand for housing and commercial properties. These markets offer higher returns than more mature markets, but they also come with higher risks. Nevertheless, investing in international real estate can be a smart way to diversify your portfolio and take advantage of growth in markets that may be less affected by the geopolitical tensions shaking other parts of the world. Now that we've covered the first solutions to protect your finances, it's crucial to understand that what you do today will directly impact your financial security in the years to come. The world is constantly evolving, and what seems stable today can quickly become uncertain tomorrow. The current crisis is only accelerating this transformation. It's imperative, therefore, to make informed decisions based on solid facts, to avoid being trapped when the global economy plunges even further into instability. Repositioning your investment strategy for long-term success. If you follow economic news, you probably noticed the enormous pressure that central banks are under. In response to the global health crisis and geopolitical tensions, they are raising interest rates and increasingly controlling monetary flows. Central banks are using these strategies to manage inflation, which has become a real concern globally, and to stimulate or control economic growth. These rate hikes can significantly influence the stock market, housing market, and even the value of currencies, making it essential for investors to adjust their portfolios accordingly. This is exactly when you need to start thinking about the future and how your money can work for you, even when the economy isn't running smoothly. Let's dive into how you can do that and explore ways to safeguard and grow your wealth. The stock market, resilient sectors, and where to look. The stock market still offers exciting opportunities, but you need to know where to look. In this time of trade wars, geopolitical instability, and potential economic downturns, certain sectors are more resilient than others. Identifying and investing in these sectors can provide stability in your portfolio and offer opportunities for growth even during uncertain times. Resilient sectors to invest in. 1. Renewable energy. One of the sectors that is expected to experience significant growth in the coming years is renewable energy. As the global economy shifts towards sustainability and reducing carbon footprints, renewable energy companies, particularly those in solar, wind, and energy storage, are poised to grow. Companies like NextEra Energy, which is one of the largest producers of wind and solar energy in the U.S., offer potential long-term returns. Investing in clean energy ETFs can give you exposure to a diversified pool of green energy stocks, which not only have growth potential but are also aligned with global sustainability trends. 2. Healthcare. The healthcare sector is another key area for investment. The COVID-19 pandemic has shown just how critical healthcare is. And as the global population ages, the demand for healthcare services will only increase. From pharmaceuticals to medical devices and healthcare providers, the sector remains robust even in economic downturns. Companies like Pfizer, Moderna, and Johnson & Johnson have all proven their resilience, especially during times of global health crises. For those looking for broader exposure, healthcare-focused ETFs, such as iShares U.S. Healthcare ETF IYH, are an excellent option for diversifying into this growing sector. 3. Technology. Despite the volatility, the technology sector continues to lead in growth. With an increased reliance on digital infrastructure, cloud computing, artificial intelligence, and cybersecurity, technology remains a driving force in the modern economy. Companies like Amazon, Apple, Microsoft, and NVIDIA are at the forefront of technological innovation, benefiting from trends like remote work, e-commerce, and the growth of AI. However, investing in tech also requires some caution, as the sector can be highly volatile. To mitigate risk, consider tech-focused ETFs, which provide diversification across various companies in the sector. 4. Consumer staples. Consumer staples, such as food, beverages, and essential household products, tend to be more stable during economic recessions. People will always need basic goods, regardless of the state of the economy. Companies like Procter & Gamble, Coca-Cola, and Unilever are excellent examples of firms in this sector that offer both stability and consistent dividend payouts. Investing in consumer staples ETFs can be a way to add defensive stocks to your portfolio, providing a steady income stream through dividends and reducing overall portfolio volatility. How to manage risk in these sectors. While these sectors are resilient, it's crucial to manage risk by diversifying your investments across different asset classes and geographies. For example, even though renewable energy is a growth sector, it's also a volatile one, impacted by policy changes, technological advancements, and regulatory factors. By holding a diversified portfolio with exposure to both growth and defensive sectors, you reduce the potential for significant losses in any one area. Real estate diversification, an asset for stability. For many, real estate has long been a reliable investment, and it continues to be a strong asset for portfolio diversification. However, the real estate market is not immune to global tensions, and we must approach it with caution and strategic thinking. Traditional real estate investment, direct ownership, owning property directly, whether residential or commercial, can offer stability and long-term growth. In a global economic downturn, real estate tends to appreciate over time as it is a tangible asset. However, buying property comes with significant upfront costs, including mortgage payments, taxes, and maintenance. The key here is choosing properties in markets with strong demand and potential for future growth. For example, major metropolitan areas with growing populations or cities experiencing an influx of investment tend to have more resilient property markets. Real estate investment trusts, REITs. For those who prefer a more passive approach, REITs offer a way to invest in real estate without the hassle of managing physical properties. REITs are companies that own, operate, or finance real estate that produces income. Investing in REITs provides access to commercial real estate markets, such as office buildings, hospitals, and apartment complexes, and offers the added benefit of liquidity since they can be bought and sold like stocks. Many REITs are also dividend-paying, which can provide a steady income stream. REITs focus on sectors like data centers, healthcare facilities, or industrial real estate, such as warehouses, have shown resilience during economic volatility. For example, Digital Realty Trust, which owns data centers, benefits from the ever-growing demand for cloud storage and digital infrastructure, which are increasingly critical in today's economy. International real estate investments. Another approach is to look beyond your home country for real estate opportunities. International real estate can offer both high growth potential and diversification. For instance, emerging markets in Southeast Asia, Latin America, and Eastern Europe are seeing rapid urbanization, driving demand for residential and commercial properties. Countries like Vietnam, Mexico, and Poland offer real estate markets that are still in their infancy but have strong growth trajectories. However, investing in international real estate comes with additional risks, such as currency fluctuations, geopolitical risks, and local economic conditions. Conducting thorough research and working with local experts can mitigate these risks and ensure successful investment. The importance of maintaining cash reserves. Cash remains one of the most underrated but essential elements of a well-rounded investment strategy. While it's tempting to dive into high-risk, high-reward assets during a time of volatility, having a strong cash reserve provides several important benefits. Why cash is king. Having cash on hand offers flexibility and security. If markets are fluctuating or if you foresee a buying opportunity in the future, having liquid assets means you're not forced to sell other investments at a loss just to access funds. For example, during a stock market downturn, many investors may feel pressure to sell their equity holdings to raise cash. If you've kept a portion of your portfolio in cash, you have the option to buy more stocks at lower prices, taking advantage of market dips. Cash reserves during inflation. In times of inflation, it can seem counterintuitive to hold cash, since its value erodes over time. However, having cash reserves is still vital for several reasons. First, they offer stability in case of emergencies or unforeseen expenses. Second, holding cash provides the opportunity to take advantage of investments when prices drop due to an economic crisis or downturn. Moreover, placing cash in short-term, high-interest savings accounts or money market funds can still generate a small yield while remaining liquid and safe. Short-term bonds and money market funds. For those who are hesitant to keep too much cash in a checking account, there are short-term bonds and money market funds that can provide a better return than a savings account while still maintaining liquidity. These investment vehicles offer a middle ground between the risk of stocks and the security of holding cash. They are ideal for investors looking for stable returns with minimal risk. Gold and precious metals, a safe haven investment. When global uncertainty strikes, investors turn to precious metals like gold as a store of value. Gold has a long history of being a safe haven during times of crisis, and it remains a cornerstone of many portfolios, especially during periods of inflation or financial instability. Gold's intrinsic value, which is not tied to any particular currency or country, makes a reliable hedge against both inflation and currency fluctuations. Why gold is a reliable investment. Gold's value often rises when there is a loss of confidence in fiat currencies or in financial markets. During the global financial crisis of 2008, gold prices soared as investors sought refuge from volatile markets. Similarly, during the COVID-19 pandemic, gold prices reached new highs as investors sought safety in tangible assets. Gold can be purchased in various forms: coins, bars, or gold ETFs. For those who don't want to deal with the logistics of storing physical gold, gold ETFs, which track the price of gold, are a great alternative. One of the most well-known gold ETFs is SPDR Gold Shares, GLD, which gives investors exposure to gold without having to store the physical metal. Thank you for taking the time to watch this video. As you can see, the current global situation demands vigilance, but also action. We're living through a time of major transformations, but this doesn't have to be a tragedy. With the right strategies, you can not only protect your money, but also grow it. Diversification, investments in resilient sectors, real estate, gold, and cryptocurrencies can help you weather this economic storm. But you must act now. Don't wait for the storm to hit. Subscribe if you want your money to work while you sleep. And, of course, let me know in the comments, how are you preparing for the new economy? I'm curious to hear about your strategies. See you very soon in the next video. And until then, stay calm and stay strategic.